Okay, so hopefully you've just watched the little 15-minute one on bond nomenclature, bond terminology, and the general approach to how people price bonds. And this is actually going to feed in a little bit to pricing shares as well. So let's just move into valuing bonds and stocks and shares. And let's just start with a reminder of the basic time value of money formulas. Okay, so future value is present value grown up by rate of interest. Present value is future value shrunk down. For an annuity, the formula is complicated. We don't expect you to remember it. If I decide to test it, I'll write it down for you on the exam. So we've got the future value and the present value. And when we've got an annuity that goes forever, the formula becomes simpler. It's just payment divided by I. And if you want it with growth, it's the initial payment divided by I minus G, where G is the level of growth. Okay, so they're the basic formulas. So let's work out where we're going today. Hopefully by now you understand bond features. So we'll have some stuff in the slides here. I'll go through that a little bit more quickly. I've talked about why bond values fluctuate. And when we talk about yields, we're basically talking about required rate of return. So when people talk about bond yields, they're basically saying, look, what are the returns on bonds in the market? Now, bear in mind that yields do tend to differ across time. I mean, if I'm asking you to invest with me for a year, you might be happier to tolerate a smaller rate of interest, rate of return. I might be happier to give you a larger one. And the reason we'd be happy to tolerate suboptimal situations is because we know we're not locking ourselves in for a long time. However, once we start talking about investing for a longer period of time, my beliefs and expectations about the future tend to matter. So now I might say to you, look, I'm happy to give you if you're a bank, I'm happy to give you a term deposit for 2% for 6 months. But I think interest rates are going to go up in the long run. So we're talking about 20 years, I'm probably going to want about 5%. Okay, so yields for different periods of time into the future are going to be different. And finance people refer to that as the yield curve. It basically reflects the fact that people have different expectations about the near future, the medium future, and the distant future. So we've talked about some of these bond features in the first little video. We'll go through those again today in this one. And then we're going to look at dividend models to value shares. They're basically going to be using the same principles, except with shares, we don't have the dividends contractually locked in. So that's what makes it a little bit more interesting. Okay, so what we're basically trying to do is use those time value of money formulas that we did before to turn a bunch of future cash flows into a present cash flow. So again, if we're comparing investments, we want to compare them both in a comparable way, right? And we basically want to say, if I'm comparing the Roman Empire GDP for 100 AD and the Byzantine Empire GDP for 1300 AD, it doesn't make sense because of inflation between those dates to compare them directly. So what historians often do is turn those numbers into $2016. Well, for the comparison to be meaningful, what we do in finance when we're valuing things is we're turning everything into present day dollars. In other words, valuation is just a present value calculation. It's really all it is. Sometimes they're a little bit nuanced, but it's pretty straightforward. Okay, so what's a bond? Look, I think I've already explained that. The bond is basically a contractual arrangement, a piece of paper that says, hey, look, if you hold the bond, then basically you are a lender to the company, and the company that's issued the bond is the borrower. It's as simple as that. And bonds can be issued by companies, corporate bonds. They are sometimes issued by non-profits. In fact, that's becoming a bit more common of late. And of course, they can be issued by government. Okay, and what they do is they guarantee a certain set of cash flows, as we've already seen. Okay, so the key things that you need to know about bonds, we've already said this: the face value, the coupon rate, which may or may not be the interest rate, the coupon payment dates and the frequency. So in the example I showed you before, we assumed it was annual, but it could be 6 monthly. Is it paid on the 1st of April and the 1st of October, or 1st of July and 1st of January? We know that the coupon payments are calculated from the face value using the coupon rate. The maturity date is when the bond terminates, so when its life finishes. In other words, the maturity date tells us, by implication, if we know the issue date, it tells us the term. Now, remember, when we're valuing bonds, we're not just valuing them when they're first issued into the market. There may already be bonds out there, and you're thinking of buying one, right? So what matters to you is what's today, how much time is left on the bond. So the maturity date helps you work out what the term is. The last thing that's important is for you to value it, and we've talked about this already, you need to work out what rate of return you actually want. Okay, and based on that, that's going to determine how much you're willing to pay for that bond. Right? Because you want to make sure that the bond gives you the rate of return that you want. It gives you your yield or your discount rate. Okay. All right, so as I've already said, we need to know what these cash flows are. So they're the face value and the periodic payments of, here we are, finance people being sloppy, the periodic coupon payments. And we're going to calculate the present value of those things. Okay, so if you have a look at this formula, again, don't stress over it. If we have a look at this formula, it's actually got two components. It's got the regular payments, which are the coupon payments, right? So we're basically taking present value of an annuity for a number of periods, and we're taking the present value of the face value from the maturity date. Okay, and maybe the first one looks a bit complex, but the second one hopefully is straightforward. It's a standard present value calculation. We're taking face value and dividing it by 1 plus I to the n. Or if you remember your high school maths, multiplying it by 1 plus I to the minus n, which is the same thing. Okay, so that's basically the valuation model for bonds. Okay, so I've just talked about that. Okay, so what we're going to do now is we're going to spend a bit of time working through some examples. And for these examples, I think we've got some formulas there. And you're welcome to go through and work through with the formulas. But, as usual, I'm going to work this through with Excel. But you need to feel comfortable that you know how the formulas work. Oh, maybe I won't use Excel. All right, so example 1. What's the price of a $100,000 10-year bond that was issued 2 years ago and obviously, therefore, has 8 years to run before the bond's maturity date? Oh, apologies. Should be an apostrophe there. Interest is paid half yearly. The last payment was made yesterday. The coupon rate is 12% payable semi-annually. Now, this last payment was made yesterday. It's sort of cool because it makes it really easy. We know the first payment is exactly 6 months away. Okay, so this thing's got 8 years to run. The key thing, though, is that it's a semi-annual bond. So even though it's 12% per annum, it's 6% every 6 months. It's got 8 years left to run. Okay, so what we've got is 8 years left to run. That's 16 periods because they're 6-month periods. The coupon rate is 12% payable semi-annually. So that's a rate of 6% per period. Right, that's your coupon. And there's your face value. And we have the key bits of information that we need. Okay, so actually, if we go back to that Excel one that I had there, face value of 100,000. The coupon is 6%, and we had 16 periods. Let me just make sure that's right. That's right. So I just need to stretch this out a bit. I should have done this before. I should have like one of those cooking shows, and here's one I prepared earlier. It doesn't matter. Okay, so there's our coupon. And let's just copy these down. Okay, face value comes in at the end. Okay, so here's basically the cash flows that are being offered by this bond. Okay. Now, if these cash flows are being offered, and they're giving you a coupon rate of 6%. For you, the issue is how much you're willing to pay for this. Now, if you're happy to pay, if you're happy to get 6%, you would probably pay the face value, right? Yeah, you would. Because it's going to give you 6% yield every 6 months, and then you get your last 6% yield and 100,000 back. However, go back to the question. Current market yield is 14% compounding semi-annually. So the market rate is 7%, right? So you actually want, so if you were happy with 6%, you're happy with 6%, you'd pay 100,000, right? But you actually want 7%. So what are you going to pay? You're going to pay more than 100,000 or less than 100,000? Remember, you can only control how much you pay. The difference between what you pay and what you get back is the yield that you want. You want a higher yield than this thing is offering. So if you give them 100,000, the difference between what you put in and what you get back only gives you 6% return. So you should give them less, because if you give them less up front, then somewhere there's going to be a level where you get 7%. Even less, you get 8%. If you gave them $1, you'd have a pretty high rate of return, right? So the smaller the amount of money you put in, the higher the rate of return that you get. Now, we'll go back to the formula in the slides in a moment, but what we're basically going to be doing is working this out is saying, okay, what's our market interest rate? What's our yield? It's 7% every 6 months. And we're just going to calculate the present value at the market rate of these cash flows. And we get 90,553. I'm not even sure if that's the one in the slides. We'll have a look in a moment. But look, if I put this back to 6%, we're happy to pay 100,000. But if we want a slightly higher rate of return, we're going to offer slightly less money up front. Okay, sorry, a few more decimal places there. Okay, 6.05. The higher the rate of return that we want, the less money we offer. In fact, let's actually put the gross return in here. The gross return is the difference between what you get back. I'm not even doing present value here, and what you put in, right? So, sorry, E6 to E21. Yeah. So if you pay 100,000, what are you going to get back? You're going to get 96,000. That's the 16 sixes. Okay. Now, if you want a slightly higher rate of return, 6.5%, you put less in, but the difference between what you put in and what you get back is now bigger. Okay, and once you go 7%, you're now getting even a higher gross return, and that gross return equates to a rate of return of 7%. Okay, so let's go back to the slides, and let's hope 90553 is actually right. Okay, so you can have a bash if you like with the formula. Feel free to pause. Alternatively, this is information we already know. So here we're calculating the present value of the coupon payments. So it's a coupon payment of 6,000. Here's the formula. That's the yield we want. Right? In all of this discounting, the coupon rate's irrelevant. Once you use the coupon rate on the face value to work out the coupon payment, you don't need the coupon rate anymore. It's only there to help you work out the cash flows. So all these calculations need to be done using the rate of return that you want. Remember, that's what the discount rate is. It's your threshold investment rate. It's the rate you're interested in. Okay, so here we are calculating the factor for an annuity of 16 periods and applying that to the 6,000 periodic payment. And here we're calculating the present value of 100,000 16 periods away. Again, it's 7%. Okay, so it's pretty straightforward, right? We discount it, and it should be obvious to you that if we want a higher rate of return, we can't control what we get back. The only thing we control is what we put in, so we put in less. So if we were happy with 6%, we would have paid 100,000. 7% means we're only willing to pay 90553. Okay, now let's go to a workshop question. Just another question. West Investment Fund is looking at buying a 20-year government bond now. The bond was issued 5 years ago. Oh, the issue date, what people were willing to pay then doesn't concern us now. All that we're trying to come up with is how much are we willing to pay now. So the bond was issued 5 years ago. So it's got 15 years left to run. It's got a face value of $500,000 and a coupon rate of 10%. Interest is paid half yearly. Okay, so you know 15 years left to run, so that's 30 periods left to run. Okay, so they've got 30 periods. Each period's got a payment of $25,000, 5% of $500,000. And then at the end, we get $500,000. West believes the market yield on the day it buys the bond will be 6% per annum. Okay, the seller will keep the interest payment due the day that West buys the bond. In other words, you're not getting the interest payment due today. The first interest payment is 6 months away. So how much are you willing to pay for it? Well, firstly, before we even go into the calculations, because they're trivial, just running through the numbers, ask yourself the question, if the coupon rate is 10%, but the market is happy with a rate of 6%, so on a periodic basis, on per 6 months, the coupon rate is 5%, the market's happy with 3%, are you going to pay more or less than the face value of the bond? Remember, the rate of return is the difference between what you put in and what you get back. Right? You are happier with a lower return. You're happy with 3% per period rather than 5% per period. So if you're happier with a lower return, you're willing to pay more. So you will be paying more than the face value. Well, let's go through the numbers. Okay, so we've got coupon payments, $25,000 period. There are 30 periods. The market yield is 3% per 6 months. So here's the present value of 30 coupon payments of $25,000 to calculate at 3%. And here's the present value of the face value 30 periods away at 3%. Okay, so 696,004. Surprise, it's bigger than the face value. And that makes sense, right? Because you are happier to put up with a lower return. Right? The return is all the money you get back. Those 30 payments of $25,000 and the $500,000 at the end. So if you're happy with a lower return, you put in more. Okay. Okay, so workshop question 2. What we've got is we've got a setup where we've got a face value of 100,000 and there are 5 years until maturity. It's got a coupon rate of 5% per annum, payable semi-annually. You might wonder why all this fuss with semi-annual payments, because a lot of bonds are actually structured that way, to make payments every 6 months. Not all, but many, especially corporate bonds. Okay, so we know the face value of 100,000. We know the coupon is 5% payable semi-annually. So it's 5% per annum, okay, 5,000 per year, but the payment is semi-annually every 6 months. So 2,500 every 6 months. Okay, so what I've done, I paused the presentation there, I did a little spreadsheet. 100,000 face value, the coupon is 2.5% every 6 months, and there are 10 6-month periods, there are 5 years left. So this is the information that we know. For the moment, I've assumed the market rate's the same. So I've just set this up and I said, okay, if you're happy with a market rate which is the same as the coupon rate, of course you're going to give face value. And what's your return? Your return is just the difference between what you put in, the 100,000, and all of these cash flows that you get back. Okay, and the cash flows are, I've never actually added them up. 125,000, right? So the difference between what you put in, 100, and what you get back, 125, is 25,000. Okay, so let's just come back to the question. We're asked, we know the coupon payments, we'll work that out. So we're asked, what happens if the yield is 6% per annum, compounding semi-annually? So that means 3% every 6 months, 2.5% every 6 months, and 2% every 6 months. We've answered B. If the market rate equals the coupon rate, people will pay face value. And we refer to that as issuing the bond at par. In other words, we're issuing it at its face value. So hopefully we go back to the next slide. Yeah, the price, if it's 5%, it's 2.5% every 6 months, then people will pay the face value, so they'll pay the 100,000. So if the coupon rate equals the required rate of return, the yield, then the price you will pay is equal to the face value. And we refer to that as a par value bond, a bond whose price is equal to its face value. All right, well that's the easy one. But let's come back to 6%, 4%. So remember the 6%, that's per annum. So that's 3% every 6 months. And the 4% is 2% every 6 months. So if it's 6% every 6 months, if people want a higher rate of return, they're going to pay less than the face value. So essentially what they're doing is they're saying, yeah, we know 100,000's there, but we need a bit more of a rate of return, so we're going to discount it. We're going to give you a lower price than the face value. And so the number that we get is 95,734.90. So generally, if the coupon rate is less than the yield, right? So if this thing is offering less than people want, then they will pay less for it. If you go back to that original slide, the price is the only thing they can control. So if this thing isn't giving you enough of a return, by reducing how much you're willing to pay, you're increasing the return you're going to get back. And that's why the price is less than face value. Let's just confirm those numbers over in Excel. So we're talking about 3% every 6 months. So calculate present value. Yes, 95734. That's right. And notice, instead of having a gross return of 25,000, we're now getting 29,000. And given the pattern, that's giving us a 3% rate of return. Okay, the other one was priced at 4%. So people are actually happier with a lower yield. Well, 4% per annum becomes 2% every 6 months. And not a surprise, if they're happier with a smaller yield, they're going to bid up the price of the bond. I mean, people are going to rush in and, oh, I'll give this much, I'll give this much. The price gets bid up to the equilibrium level, which is 104,491. So by pushing the price up, they get a lower return. Okay, and in fact, that's what's happening, right? The coupon's offering 2.5, but they only want 2, so they're happy to pay more for it. Okay, and we refer to that as a premium bond. It's a premium because people are paying for that bond above the face value of the actual bond. Okay, so that's workshop question 2. Okay, so I hope that's reasonably straightforward. The key thing to get out of bonds is the terminology. I mean, that's a little bit freaky. And to be honest, the thing that used to really freak me out, even when I was studying finance first up, this idea that interest rates go up and bond prices go down. What's going on there? How does that work? It seems something was a bit funny to get my mind around. But if you think about what a bond really is, it's basically a contract with some fixed cash flows, and you're looking to buy this thing. You go into the market and you're saying, look, dude, I don't think you're giving me enough of a rate of return. So I can walk away, but walking away is just another way of saying, hey, look, I really want to pay less. And if enough people walk away, the guy's got to reduce the price until there's an equilibrium there that gets people in buying that bond. So if you're looking to buy a bond, your optimal response is to say, look, if the yield's not enough, if the coupon is not enough, I want a higher yield, I'll just pay you less for it. Okay? Alternatively, if I'm happy with a lower yield, hey, this bond's great, it's offering a higher yield, let's see if I can get in early, but the price will quickly be bid up to the equilibrium level where the yield that you get out of it is equal to the yield that people want. Okay, so it's a relatively straightforward concept. You can only adjust the price, you can't adjust the cash flows that are going to be happening in future. And that's why you pay a different amount. The present value calculations, pretty straightforward. The only thing that's really complicated is remembering that the interest rates and the coupon rates are always quoted per annum, but often the payments are every 6 months, so don't forget to divide by 2. And when they tell you how many years are left in the bond, don't forget to multiply by 2 because there's twice as many 6-monthly periods. So if you know the cash flows every period, you know how many periods, and you know the face value that you're going to get at the end, then you know the entire set of cash flows that are being offered. If you calculate the present value of those cash flows at your required rate of return, your yield, your discount rate, whatever you want to call it, that will tell you how much you should be willing to pay for that bond. If you want a bigger rate of return, you'll pay less. If you're happy with a smaller rate of return, you'll pay more. Okay, so get your mind around those concepts. That's bonds. We'll use a similar procedure to talk about valuing shares, but we'll do that in the next one.